Welcome everybody to our third panel of our 14th Annual Investment Management Regulatory University. I'm Stephanie Monaco, and I'm very pleased to introduce our third panel. Before doing that, as some of you know, because I do see repeat offenders on our attendee list, we are preparing and presenting our Investment Management University this year each Wednesday in September. We've done our hot issues panel. That was our first. Our second was stray cats and regulatory dogs of GDPR, ESG, privacy, and cyber. Today we're going to talk about steering the course for growth of global asset management products, or our always popular fund developments panel. Next Wednesday at noon, we will have our enforcement panel where we will discuss DOJ interests in money managers, key enforcement trends, issues associated with remote working and stimulus fraud. And our last panel for this year's Investment Management University will be on the 30th at noon, and that will be our ethics panel, which we are applying for an ethics CLE credit. I'm not sure we're going to get there, but we're doing everything possible to try and do that. Before I hand this over to our partner, Wendy Gallegos, for as the moderator for the panel, I have some housekeeping notes, and then I like to try and throw a little humor in here, although it does feel like I'm a baseball player playing to an empty stadium this year. So if you want to ask questions, you will see the Q&A widget on your screen. We try very hard to address questions throughout the panel, but otherwise we may have to get back to you through email. We will do so. For those of you seeking CLE credit today, please download the affirmation form and the evaluation form found in your resources widget on the screen. We will announce the CLE code once during the middle of the presentation and once again at the end. Please return both forms for CLE credit. The presentation and supplemental materials are available for download from your resources widget. We will also distribute these through email after the webinar. Before I turn this over to Wendy, I've picked as a theme this year ambiguity. It certainly seemed appropriate as an overall topic when talking about GDPR and privacy and ESG. Things are quite ambiguous. And to everyday people, there's a lot of ambiguity, such as if a parsley farmer is sued, can they garnish his wages? That's a pun. For example, another ambiguity, why do they lock gas station bathrooms? Are they afraid someone will break in and clean them? And lastly, I will just ask the ambiguous and rhetorical question, can vegetarians eat animal crackers? So with all of that ambiguity, I'm turning it over to you, Wendy, who never drafts. I've never seen you draft a fund document with any ambiguity. Things are as clear as mud always in the fund business. Take it away, Wendy.
Thank you, Stephanie. Good afternoon, everyone, and thank you for joining us for today's funds panel. A lot has changed since we last gathered for IMU, and there is a lot of noise in the market today about the impact of recent market disruptions on private equity funds and the various asset classes in which we all invest. At a macro level, the news is at best mixed. I think Preqin reports that fewer funds are being raised and the new capital is concentrated almost exclusively in mega funds raised by the largest sponsors. At a micro level, however, our experience and that of our clients has been very different. We have seen sponsors of all sizes having success raising capital in today's market, particularly from certain classes of institutional investors and for certain alternative asset classes. So today on this panel, we are going to focus on these micro trends. We have gathered for you an excellent panel for today's discussion. With me here today are Tram Nguyen, Frank Falbo, Brian May, and Kristin Rylko. All four are members of our global private funds practice. Tram will speak to us about the growing appetite among insurance companies for private equity investments and how sponsors can structure investments to meet the regulatory requirements of these investors. Frank is going to provide an update on an asset class that has seen a lot of recent volatility, real estate. Brian will provide an overview of how current market conditions are affecting the terms of investment at the asset level, particularly focusing on how fund sponsors are using investment terms to protect against market risk. And finally, Kristin will give us an update on how recent market conditions are affecting the availability and terms of fund finance products. We will start with Tram Nguyen. Tram is a partner in our New York and DC offices. She advises hedge funds, private equity funds, venture funds, and other investment funds on all aspects of fund formation, fund structuring, and capital raising. Tram was the inaugural branch chief of the private funds branch at the SEC Division of Management in Washington, D.C., so we have Tram to thank for some of the rules and regulations under which we live today. And Tram has extensive experience representing asset managers and financial institutions on regulatory matters. More recently, Tram has been working with a number of sponsors to design platforms and structures to attract insurance company capital. Tram?
Thank you, Wendy. We're going to start our segment with a focus on U.S. insurance companies, first as investors in private fund strategies. At the end of 2019, insurance companies held over $7 trillion in cash and investable assets. Of this amount, approximately $402 billion were allocated to so-called Schedule BA assets. These are assets generally categorized as long-term alternative assets encompassing private fund investments. This amount represented roughly 6% of all investable assets held by U.S. insurance companies. As a comparison, in 2008, Schedule BA assets only represented 3.8% of all U.S. insurance company investable assets. As these charts show, insurance companies invest in all kinds of alternative assets. According to the 2015 Preqin report, regardless of size, insurance companies invest across private equity, real estate, infrastructure, and hedge funds. All indications are that this trend will continue. In late 2019, Natixis conducted a survey of 200 chief investment officers at insurers based in North America, Asia, and Europe. Nearly 75% indicated that it was essential to include alternative assets in their portfolios and to outsource this expertise. Insurance company CIOs identified private equity, private debt, real estate, and hedge fund strategies as being the top asset classes for outsourcing. In another survey conducted by BlackRock, over 1/3 of insurers indicated that they plan to increase their allocation to private equity, fixed income, and real estate over the next 12 to 24 months. The one caveat is that this survey was conducted prior to COVID-19 and the recent disruptions, so we'll see how that pans out. Moving to the next slide, the question that we're going to focus on is what is the source of the increased focus on private funds by insurance companies? First, low interest rates have pushed insurance companies to seek higher yielding assets. We have been in a low interest rate environment since 2008 following the financial crisis. At the same time, insurance companies must now manage near record levels of assets. These competing pressures have made it increasingly difficult to match portfolio returns with the long-term liabilities that insurance companies must typically manage. Second, the search for higher yielding portfolios and non-correlated returns have led insurance companies to alternative assets. This is an expansion beyond their historical focus on core fixed income investments. For smaller insurance companies without the internal resources yet to evaluate and monitor the risks associated with alternative assets, relying on third-party managers to provide risk management and portfolio management is a useful way to bridge the gap as their exposure to alternative assets grows. At the same time, Fund sponsors also see insurance companies as a major source of capital. In short, insurance companies provide a more permanent form of funding given their time horizons. This makes them ideal investors for strategies that require a significant long-term commitment, which is typical for private equity, real estate, and infrastructure. So moving to the next slide, the question is, what are some of the challenges and considerations that insurance companies must confront when allocating to private funds? The first and most significant issue for U.S. insurance companies is risk-based capital. Other than direct U.S. government obligations, all investments are subject to risk-based capital charges. Investment-grade debt is subject to a lower RBC charge than below investment-grade debt. Currently, risk-based capital charges are measured on a 6-bracket scale, the lowest being 40 basis points and the highest being 30 percentage points. For U.S. insurers holding a limited partnership stake in a private fund, this means that they're typically subject to the highest RBC charge at approximately 30%. Translated, this means that an amount roughly equal to 30% of an investment in a private fund must be set aside in the event of insolvency of the insurer. Interestingly, RBC capital charges and also investments in private funds, to no one's surprise, is subject to increased regulatory scrutiny. First, there are proposals to increase the level of granularity on the current 6-bracket scale towards a 20-bracket scale. State insurance regulators and the NAIC are also looking at more closely evaluating whether or not equity stakes in private funds are being converted or structured into more debt-like instruments. If they are treated as principal protected securities, quote unquote, beginning in 2021, the Securities Valuation Office will need to evaluate the investment and determine whether or not a greater risk-based capital charge may need to be applied. Moving beyond risk-based capital, private fund sponsors who have long had insurance companies as investors will be familiar with the following requirements. The first is ERISA. General accounts may contain ERISA assets, and as a result, ERISA considerations will need to be applied when accepting insurance company assets. The first being counting those assets towards the 25 ERISA plan asset threshold. The second consideration is state law requirements. Insurance companies are subject to regulation by the respective states in which they operate. State law requirements may impose limits on how much an insurance company general account may invest in any particular asset class, as well as the composition of the entirety of the portfolio. Finally, the nature of the insurance company itself may be very relevant because whether the insurance company is a life insurer, a property and casualty insurer, or a health insurer, all of these considerations will be applied on a very different basis. Therefore, it's going to be very important for private fund sponsors seeking to grow their assets and their private funds to take into consideration all of these factors when dealing with insurance company investors.
So, Tram, what can private fund sponsors do to attract investment from insurance companies?
So, like any good lawyer, the answer is it depends, and there is no one-size-fits-all approach. Generally, the options available to a private fund sponsor will depend upon whether or not the insurance company investor is subject to first U.S. or non-U.S. regulatory considerations, whether it's in the area of risk-based capital charges or the type of investor, a reinsurer, a life insurance company, or a property and casualty insurance company. All of the things we've talked about will be different. As a simple example, a portfolio of consumer loans may receive better treatment under Solvency II requirements, currently under 5% relative to existing NAIC treatment, which would be a 30% risk-based capital charge. So the difference can be very significant, and the insurance companies themselves may be very much attuned to different options, and depending upon their risk appetite. We've also found that larger insurance companies tend not to be as constrained by RBC charges. They're going to be more focused on issues such as reporting and transparency and governance relative to some of the smaller insurance companies who are investing in private funds.
Excellent. Thank you very much, Tram. So switching from a class of institutional investors to different classes of assets, next we will turn to Frank Falbo for an update on trends in real estate. Frank is a partner in our Chicago office and has experience with a number of credit, infrastructure, and real estate funds. Frank concentrates a substantial portion of his practice on real estate funds, including real estate debt funds. Frank represents several of the largest sponsors of real estate debt funds and probably has more experience structuring these funds than any other current practitioner. Frank?
Thank you, Wendy, and I'll add my welcome to everyone. Thank you for joining us today. First off, just as a general observation, I will echo Wendy's introductory thoughts earlier that the fundraising market, I think, in the real estate fund space has been active, although, as you might expect, there is some longer timelines. Although even in recent weeks, I've been seeing investors re-engage on investments that they've been putting aside or partially finished as they are thinking they're getting some better clarity on where the market is today. And as you might imagine, part of what sponsors are considering, given the current dislocation caused by COVID-19, is how should they revise or re-examine their product offerings in light of what's available in the market and opportunities that have arisen given the market dislocation. And in particular, focusing on the real estate debt fund space, as Wendy mentioned, sponsors are looking to capitalize on, I think, what you most often see as special situations type debt opportunities. And given the uncertainty as to what will continue to be available in the market as far as these kinds of deals, most often you see these mandates fairly broadly defined. And on the slide in front of you, I've just put a few bullet points here showing how some sponsors are describing the types of deals that fit into these buckets. And there's a bunch of different other categories you can describe, but this is a kind of a good example. And obviously the next logical question is, what will be the source of capital to pursue these types of investments, and how can those pools of capital short-term to make sure funds are available to pursue these opportunities while they exist. For sponsors that are currently marketing this kind of asset, I would see within the closed-end fund, given the risk profiles associated, they've certainly been considering expanding the investment scope of that fund to cover these asset classes. And depending on where you are in the fundraising, it may be more or less difficult to expand that scope. For example, if there's been a closing, there really has to be a pretty serious examination of what the scope is already and whether this fits within the style or investment mandate of the fund, or whether certain approvals might be needed under the documents to expand into different kinds of debt investing. And I think along with that, so sort of the broad approval consideration is consideration of whether the things like investment limitations might need to be tweaked or expanded or have certain carve-outs to make sure that this type of investment doesn't trip you over the line. Again, more of a concern certainly if you've already closed the fund and agreed to certain limitations that will need to be reexamined in light of the expanded mandate. But I think another avenue that sponsors have been pursuing, and one which I've been seeing a significant appetite, is to pursue either a separate account, fund of one, or other sort of club structure in order to obtain the funds in the short term to pursue these opportunities. And as a general matter, as I think we all know, given the smaller number of investors in these products, they usually can be raised on a quicker timeline, allowing the sponsor to deploy the capital sooner. Sometimes these products might be used as an interim source of capital, meaning there is a commingled fund product in the pipeline that will also be pursuing these types of opportunities. And in those cases, thought needs to be given as to how to deal with situations where, for example, this separate account or fund of one or other club arrangement, is not able to deploy its capital or all of its capital in the time horizon before the fund gets raised. And, we've been seeing sponsors consider things like the ability of those fund of one or SMA investors or club investors to roll over any remaining commitments over to a fund structure when that's up and running, or perhaps even arrangements where the fund structure might co-invest with the existing either separate account or other type of smaller investor arrangement. Those can be a little bit tricky, as you might imagine. Oftentimes, sponsors really can't be in a position on a co-investment type arrangement to be removed separately from the fund, but the SMA or fund of one or club investor wants to retain flexibility to choose its manager with respect to its wholly owned assets. And so those typically would result in some sort of bifurcated arrangement where you might have separate structures to deal with the wholly owned assets versus the co-investment assets. And finally, I think I'd note with respect to this bucket of investing, with respect to what the economics are, I think you're seeing, in many cases, either higher preferred return hurdles and or higher splits on incentive compensation side for the sponsor, given the assets that are being pursued in comparison to other types of debt investments that the sponsor may have been traditionally pursuing. Moving to the next slide here is another sort of corollary development as a result of the market dislocation. And here we've been seeing an increase in interest in investing in CMBS or other real estate debt securities, including publicly traded REIT securities. And here, as you might imagine, sponsors are often looking to acquire mispriced securities that result from the market dislocation. And this, I think, unlike the prior special situations fund lending, which, in my experience is focused more on the closed-end space, you're seeing both closed-end and open-end fund sponsors look into various types of real estate debt securities that might be mispriced for their portfolios. And I think similarly to the special situations lending, they may be pursued as part of an existing fund, or they may be part of a new fund strategy that focuses solely on these kinds of investments. For existing funds, again, the initial question often turns to whether these types of investments are permissible. In most cases, in many, if not most cases, I'd say the documents are broad enough to permit this type of investing. And of course, depending on how significant this is intended to be as part of the portfolio, you have to re-examine things like, is this too much of a style drift, or are there concerns, again, with certain limitations that might need to be tweaked or otherwise dealt with because of this subset of assets that the fund will be pursuing. And usually we would also recommend, to the extent not specifically addressed, augmenting any disclosure you might have to talk about these specific types of assets that will be pursued. I think with respect to the scope of what sponsors might be pursuing in these kinds of real estate debt securities, it can be broadly defined or more narrowly defined. And what I mean by that is certain sponsors, for example, may focus on things like single asset or single borrower CMBS because they think their real estate expertise will give them the opportunity to underwrite more specifically these smaller pools of assets, which will give them an advantage in determining, if there is a mispricing situation and a good opportunity there. I think I should also note that although there is, I think, good investor interest in this line of investments, it seems that some investors are holding off at least temporarily to get a better sense of whether there's sufficient mispriced opportunities in the market today, and also whether there will be another wave of dislocation that might bring about additional opportunities. So I think it's certainly still out there. It's just people are taking a little more of a harder look just to make sure there's sufficient availability in the market to pursue these kinds of investments. And then turning...
Frank,
sure.
It's Stephanie. I just want to throw in a question here. I'm just curious. For the sponsors of products that are looking for these kinds of investment opportunities where the sponsor typically is a registered investment advisor and they are on the hunt for these dislocation instruments that may be attractively priced, are these sponsors, when they have open-end, closed-end, sidecars, co-investment vehicles, and separately managed accounts, are their allocation procedures struggling a little bit? How do they, for example, encounter a problem when they find an investment opportunity that's very limited? How do they allocate them among the variety of accounts that they have in a fair and equitable way when they don't know if another opportunity like this will come down the pike or be sufficient?
Yeah, I think that's a great question, Stephanie. What I would say is just somewhat by luck, in a lot of the circumstances where I've been encountering this, there has been some ability because there have been the competing products have been in sort of the fundraising phase to have a manner of specific carve-out for at least a certain subset of these assets. But I think as a general matter, it really depends on re-examining the allocation procedures in light of this, because I think some sponsors have more built out procedures for this type of asset just because they've more historically pursued them, or even if they've pursued them in prior dislocations, where others really this is a new, more of a new focus for them, and so they sometimes have to re-examine and determine, whether those procedures need to be augmented, and then, frankly, whether certain amendments or other consents or approvals might be needed under their documents. So I don't know that there's one answer for everybody there, but it's certainly another important consideration when you're moving into these types of investments to re-examine not only where you think it will fit in a particular product, but where it might cause other issues with other products that might have broad enough mandates to capture these.
Right. Thank you.
So I think I'm going to go quicker through this one because I think I'm kind of running through my time here, but I did want to mention on this final slide open-end fund debt products. I think these have been in the market for a while. I would describe them, at least in my estimation, as maturing a bit in the sense that both investors are aware of these products and seeking them even more actively than even in the past, and sponsors that either have traditionally been closed-end debt fund products are definitely looking for open-end products to complement their strategies, or even maybe considering an open-end product to be its first entry into the market for a commingled debt product. I think sponsors like these for various reasons, including certainty, relatively stable and certain management fee cash flow, and the ability to reinvest, more freely than you might see in a closed-end fund product. Investors, I think, are attracted to, in most cases, the safer nature of these kinds of investments, and the fact that they are often targeting, current yield type investments. The other thing I think to mention on these last couple bullets here is, Tram mentioned insurance company investors earlier. It is important, given that these are open-end products, to provide, flexibility to structure in a way that allows you to attract the most different kinds of pools of capital, either upfront or through the ability to revise the documents in order to do that. The other item I've called out here, in addition, is defined contribution plan money. I think most people think that will become an increasingly important pool of capital. So you see many open-end funds, both in the debt and equity space, making sure they, if not upfront, have the specific structuring needed for those kinds of investors, reserve the right to revise in the future to make sure that pool of capital is available to them. So just to end, I guess I'd echo again that the market remains active, and I think is very quickly adapting to take advantage of the opportunities presented by the current dislocation.
Thank you, Frank. Next, we will turn to Brian May for an update on asset level trends. Brian is a partner in our Chicago office and has extensive experience representing fund sponsors, both as fund counsel and as deal counsel. Brian has extensive experience working with U.S., European, and Asian funds in various asset classes, and over 2 decades of experience deploying capital for his fund clients. In the last few months, Brian has been frontline in negotiations between fund sponsors and operators. Brian?
Thank you, Wendy. In March, as there was the initial shock of the stay-at-home orders and the pandemic, we saw transactions being paused largely across the board, including so much that we saw buyers walking away from deposits. More recently, the effects of the pandemic have become more nuanced and really vary significantly by asset class. In the industrial space, where we saw early effects prior to the shutdown even, because of disruptions from imports in the Asian supply chains, there's more recently been a recalibration in the spring and over the summer, particularly in the e-commerce, grocery, and logistics spaces, where we're seeing significant activity. Data centers have continued to be a positive growth story, but require specialized knowledge and skill set that make them relatively unique for our clients. Self-storage, we're seeing continued growth as we have for several years. It's still very active and seeing a number of transactions geographically dispersed. Medical office, there was an initial and substantial hit from the stay-at-home orders and bans on elective surgery that were present in many states. That has weighed against the continuing demographic shift that still supports medical office, and we're continuing to see substantial activity. Residential single family, which was largely born from the last financial recession and the foreclosure boom that accompanied that has produced some major public companies such as Innovation Homes and American Homes for Rent. Now we're seeing where that was purchasing foreclosed homes, moving over into development and developing new communities, seeing significant growth there as people have, from the pandemic, rethought their space and seeing migration to suburbs and secondary markets, which has supported interest in single-family homes from many of our clients. Residential multifamily, at the lower end, we're still seeing strength and seeing transactions, less so at the higher end and in the city centers and new development, as concerns regarding the recession, governmental restrictions on eviction, and tenants' ability to pay rent continues to weigh on the sector. I've set up this slide so as we move over to the right, where we're seeing much fewer transactions, much less activity in office with the effect of the stay-at-home orders combined with the relative success of remote working and significant headwinds from the recession. Likely seeing a longer-term decline in net office demand, and as a result, we're not seeing much activity, and what we are seeing, it tends to be pretty costly financing in terms. Senior living, the COVID-19 effects pretty pronounced, inability to have tours and onboarding, as well as the effect on their existing residents. We're just not seeing deals in the space. Retail, again, the focus on rent concessions and forbearance agreements with lenders. We're not seeing transactions where properties are actually trading yet, although I expect as we see more distress, that'll become more common. And then finally on hospitality, similarly, not seeing transactions, but rather a pause on development plans. So the effects that we've seen on venture transactions and how people are structuring around that. We're seeing more preferred equity structures, both in an absolute sense, where the investor will receive a full distribution of their capital plus expected return before the operating partner sees anything, as well as within the waterfall, so that the investor receives its capital back and a portion of its return, and then the operating partner would receive its share throughout the levels of the waterfall. Also seeing an increase in promote hurdles to offset the risk to the investor of the current climate. Increased co-investment by operating partners to strengthen alignment of interests and reduce the risk to the investor. And also seeing financing contingencies reemerge, both in terms of actual financing contingencies, but also generally an appreciation for the sensitivity around the debt markets and making sure to be exploring the debt markets at an earlier stage than what we would have seen a year or two ago when our clients generally were more confident about being able to finance assets. In connection with that, we're also seeing our clients make decisions about, within a portfolio, what are the best assets to finance. For example, perhaps if a loan's maturing in a retail property, rather than seeking to refinance that asset, which may not be achievable, or at least achievable on favorable terms, thinking about other assets in the portfolio that may be easier to finance, such as industrial or multifamily. In the development space, tools that we're seeing include reconsideration of construction cost estimates. Clearly still a lot of unknowns in terms of those cost estimates on the availability of labor, potential work stoppages, interruptions in supply chains, but there was, at least we saw initially after March, the thought that costs are likely to be coming down over the course of the next 12 to 18 months, as opposed to what they have been, as there's less development, less construction. A reallocation of cost overruns, shifting some of the risk over to the operating partner, to have the operating partner guarantee more on the cost overrun front. And also we're seeing provisions where investors on development deals, particularly in the hospitality space, have the opportunity of revisiting whether hospitality will still make sense before you actually put a shovel in the ground, so that there's an opportunity to not be fully committed that that's going to be the use of the property. Unlikely that the investor would succeed in dictating a potential alternative use. Hard to tell an operating partner that specializes in hotels that good news, I've decided to build an office building here instead, and you're going to come along with me. But what we are seeing as a potential remedy there is if the investor determines subsequently that the hotel doesn't make sense, if that's what they had planned on building, having an opportunity to cause a disposition of the property rather than moving forward with the development. And then finally, we're seeing an increased focus on force majeure provisions and the pandemic. Provisions are very common to see a force majeure provision in development transactions. They tend to be very generally written and generally include pandemics, but it's important to be looking at those provisions and thinking about what we know now, 6 months in, and what effects we are seeing with respect to stay-at-home orders and the like, so that we can make sure that the parties are in full agreement as to what the consequences of those should be.
And so, Brian, in terms of those force majeure provisions, thanks. In terms of those force majeure provisions, are you seeing the allocation of risk for pandemic and pandemic-related costs and delays typically borne by the capital partner or by the operating partner, or is it a mix?
I would say it's a mix. I think what I am seeing shift are the costs that you know about. You can, depending on the state you're in, you should now have some sense of what does a stop order from the state, for example, in the state of Michigan, where construction wasn't permitted for several months in the spring, what does that look like? And you can determine with your eyes open what should be the consequences if such a stop order were implemented. Because, for example, in construction in Michigan, where there was an affirmative stop to all construction, in Illinois, that was deemed a necessary service and construction continued. So it is important to kind of think about it in the geography of where the transaction is based.
Wendy, if I just want to throw out a question, and it's to all of you really, Frank, Brian, Wendy. I know I think you've seen this, but during this tumultuous time, what are you seeing in terms of valuation issues? Again, just, to lay my own foundation on that question, investment advisors that are registered have fiduciary obligations. Valuation of assets is critical from a couple of perspectives. One, in terms of calculating all fees. And two, there is some marketing still going on, and it seems that in every pitch book that I look at these days, there is, of course, existing fund performance. What I have unfortunately seen a couple of times, at least through June, was 1231 valuations, which I am very, very concerned about if, in particular, the valuations of the property post and during the COVID-19 period have been materially different, and there's no disclosure about it. So what are you all seeing in terms of struggles for valuation, if anything, during this period?
I'll take that. I'll take an initial stab at that, and then Frank, Brian, and Tram, please weigh in. At least on, I think there was a significant amount of disruption and consternation on the open-ended funds early in the pandemic, particularly at the end of the first quarter, and a lot of different funds were trying to make decisions about how solid is the NAV? Should we be trading on this? Should we be redeeming on this? Should we be bringing in new capital? There were dilution concerns. There was a lot of consternation about how comfortable we were with the 12/31 values in light of the changes over in early March. I think over the course of the next few months, those values have not changed as much as we would have otherwise expected. There's some institutional capital that's sitting on the sidelines and intends to sit there through the end of the year, waiting for what they view is likely to be more appropriate valuations towards the end of this year. But we haven't seen massive write-downs. The core funds are still seeing good income streams off of most of these assets. And retail hasn't traded, but there's there's obviously concerns on pockets, but we haven't seen the massive hits to values that we were fearful of in the early quarter, and I at least that's my experience. And so, in looking at track records, we've had a lot of pretty heavy-handed language talking about the fact that these are 12/31 numbers and that predated the pandemic and that the pandemic was likely to have a material adverse effect on these numbers. We've been trying to push out March 31 numbers didn't show much of a change, but we've been trying to push out June numbers as quickly as we can. But we've been trying to disclose the risk. I think that's all we can do. We don't suggest just not including. There isn't. It's difficult to go back far enough to make that not an issue. So we just have to disclose the fact that there is that risk. But we haven't seen, at least I haven't seen, in the funds with whom I've been working, a huge change to the valuation such that those track records aren't valuable or informative anymore. And others, I would welcome comments, and even those on the attendees list who probably have more direct experience with looking at the appraisals, please feel free to weigh in.
Yeah, this is Frank.
Brian,
Go ahead, Brian. Sorry.
From the transaction side, as the outside lawyer, you only really have the better feel for it when a repricing occurs on a transaction that's pending. We definitely saw some repricing in the spring, relatively modest given everything else that was happening at the time. But you're only seeing that on transactions that occur. So in the hospitality and the retail, even the office space, where the effects are greatest, because we're not seeing transactions. You don't get a sense for what the values would be.
Yeah, this is Frank. The only thing I was going to add, I was basically going to agree with everything Wendy said, and that my experience has also been there hasn't been sort of a wide scope, just decrease in NAV across the board. It's been, particular assets, a few within the portfolio may be problematic and a little bit more difficult to get your arms around the valuation, but as a general matter, not a sweeping, decrease across the NAV in the ways we might have expected earlier in the year.
Great, thank you.
Thank you, Stephanie. Thank you, Brian. Last but not at all least, we will turn to Kristin Rylko for an update on fund finance. Kristin is a partner in our banking and finance group and represents a variety of financial institution and investment funds across a broad range of lending transactions. She's a core member of the fund finance team and has extensive experience structuring complex financing transactions for private funds, fund sponsors, and portfolio companies. Kristin?
Thank you, Wendy, and good afternoon, everyone. Since the fund finance market is impacted by fundraising and broader private capital market dynamics, I thought I'd start with a few statistics to frame the discussion in this segment. According to Preqin, coming into 2020, private capital assets under management has grown every year in the last decade and surpassed the $7 trillion mark last year. Private capital dry powder as of August 2020 was at a record level of almost $2.5 trillion, which is more than double the level seen during the GFC. The end of 2019 saw 3 consecutive years of over $1 trillion per year raised. Though 2020 may not hit that mark, as we've seen the makings of the first dip in the pace of fundraising in the last decade. Further, funds with more than $1 billion of committed capital represent almost 70% of all capital raised year to date in 2020, continuing the trend mentioned by Wendy of ever larger funds and a perceived movement of LP dollars towards more established sponsors with a longer track record. In terms of the more immediate impact of COVID-19, Preqin has reported that the number of private capital fund closings is down over 40%, but aggregate capital raised is down just 11% in each case versus the previous 3-year average. And while buyout and private equity real estate deal activity volume is below that of recent years, venture capital deal volume is reportedly holding steady. All told, while there's a record amount of AUM and available capital to private fund managers, COVID-19 has blurred the picture a bit, with future fundraising and the rate of deployment being key drivers to watch with respect to total available capital levels through the end of 2020. As available uncalled capital is the primary collateral supporting subscription credit facilities, these broader trends will impact the size and growth of the subscription credit facility market, which is where I'd like to start. As with a number of lending products, when COVID-19 hit, there were concerns about which deals in the market would in fact get done. There was initially a flurry of activity as managers pressed to close deals and agree credit facility extensions in an effort to lock down certainty of liquidity. Banks initially reacted to COVID by becoming more selective in this space. There was also anxiety in the market around whether LPs would continue to fund capital contributions, obviously a concern for a subscription credit facility lender. And it pleases me very much to say that so far, there have not been any known material institutional investor defaults over the last few quarters in funds with subscription credit facilities. Similarly, there's no known material stress in existing facilities that has been reported in the syndicated market. As a result, overall product performance for subscription credit facilities has remained positive during COVID-19 thus far. That said, demand for subscription facilities has at times exceeded supply, and as a result, we've seen draw pricing trending higher, with temporary and permanent LIBOR floors greater than a zero appearing more frequently than they did pre-COVID-19. Perhaps quite expectedly, lenders have become more comfortable with shorter tenors. Thus, we see deal terms with more compressed timelines to maturity, and uncommitted as opposed to committed extension options are becoming more prevalent. With bank credit functions tightening, there has been heightened scrutiny of deal terms and covenants, with transactions taking longer to complete. So if you're planning on being in the market, expect negotiation time to be a bit longer than usual. It's also interesting to note that the subscription facility space did not see the rush of full facility drawdowns as was observed in the corporate lending space when COVID hit. Line usage has generally remained within the range of normal activity levels during the pandemic so far. Further, caution by some existing lenders in this space and managers looking to secure lines on the best, most competitive terms has created opportunities for newer and smaller players to expand their footprint in this space, which we've also observed recently. All in all, the market seems to be settling. We seem to be in the middle innings, as it were, of the COVID epidemic, with lenders still actively structuring and closing new lines, albeit perhaps on slightly more lender-favorable terms. In addition, we've seen increased interest by sponsors in net asset value lines, which are often structured as fund-level borrowings supported by the equity value of the underlying portfolio companies of the fund. These types of products and lines permit a fund to access liquidity by leveraging its underlying assets. Sponsors have been tapping NAV lines as a reaction to COVID to both support portfolio companies through a difficult time and also to take advantage of investment opportunities. Diligence for NAV lines can be intensive even in the best of times, and the pandemic has only intensified that process. Unfortunately, we've seen deals get hung up in the later stage of diligence, and I expect that's likely to continue to be a trend until we come out of COVID. Because NAV lines remain highly bespoke, it is difficult to give generalities on terms and pricing and covenants, other than to say these products are gaining traction among sponsors, and competition is increasing as debt and credit funds, who are the dominant providers of credit in this space, continue to enter the market. Further to Frank's observations, these products do present a potential opportunity for new investment by managers. We've also seen an uptick in interest in preferred equity as an alternative to debt financing at the fund level, particularly where the fund's partnership agreement limits the incurrence of additional debt or the manager is seeking more flexibility around terms. For example, no or limited operational covenants or no fixed hard maturity date. The providers of capital in the space are often specialized funds themselves. We expect interest in preferred equity to continue to grow as an alternative fund liquidity source. Taking a moment to look at top-of-the-house debt products, those that sit above the fund level, we've seen an uptick in the number of partner and employee co-investment loan programs and GP support facilities closing in recent months. We believe these facilities are becoming more popular because they can provide certainty of partner and employee capital contributions, alleviate initial cash outlay burdens on program participants as they make contributions to the funds that are supported by these facilities. These lines can streamline the contribution and collection process for managers and also potentially permit the GP and its principals to make larger capital contributions to their funds. Similarly, we've seen continued appetite for management company lines as a means of providing working capital to managers. These lines can also be used to finance dividend recaps, partner buyouts, and in some cases to provide liquidity for opportunistic expansion into new investment strategies. Finally, I think it's worth mentioning that we have seen more interest around fund restructurings and GP-led transactions as a means to give GPs more time and capital to manage their portfolios and act opportunistically. We anticipate there will be increased interest in these types of transactions and related secondaries market trades and financings. And in thinking about undertaking this type of transaction, it is, of course, always prudent to check any existing fund debt documents before embarking on that kind of transaction to confirm there are no impediments to doing so, in addition to, of course, reviewing fund documents, checking for LP consents, and considering disclosure requirements as part of such an arrangement. In conclusion, overall, we would anticipate an active end of year for the fund finance market as funds and managers look to secure alternative sources of liquidity to ride out the uncertainty created by COVID-19 and also to take advantage of potential investment opportunities.
Thank you, Kristin. I know we just have a few minutes left. Are there any new fund finance products that you see emerging or that are changing due to recent conditions?
Yes, certainly we are seeing some terms tighten. As I mentioned, in some of the existing products and preferred equity and NAV lines, I think are going to be an area to watch in particular. We've also seen the first ESG subscription credit lines and fund private placements happening in the market across the U.S., Europe, and Asia, which is an exciting development. And the interesting thing there is some of these ESG transactions in the fund finance space have actually had pricing differentials based on achievement of various metrics, which is not something that has been as common for those kinds of financing products outside of the fund finance space.
Kristin and Stephanie, I want to just ask you a question on the management company lines. Are they typically secured or unsecured lines? And when they're secured, how do the management companies secure the lines?
Yeah, it's not unusual for the management company lines to be secured by the advisory income that is received by the manager, so the management fees that are being paid by the underlying portfolio, the underlying funds and potentially separate accounts, et cetera, that are managed by the manager. Sometimes the lines are structured solely with respect to having a security interest in a collection account into which the management fees are paid. There are also unsecured deals observed in the market as well.
And so, Stephanie, go ahead. To answer your question, we're being very careful not to pledge the GP interest for the reasons that you're about to highlight.
Well, I'm not going to devolve this fascinating conversation with the boredom of anti-assignment provisions under the Advisors Act, but I've always found it interesting, and Kristin, I know you and I have dealt with this before, that a lender is willing to secure the line of credit or the loan with revenue and fee income subject to an advisory contract that allows for termination or an LPA agreement. I presume that they're comfortable enough to know that effectively the termination, for the most part, in a limited partnership or pooled situation is for cause only, for the most part. Is that right, or am I smoking?
No, I think that's generally the case, and these types of products, do rely very much on underwriting the particular sponsor and getting very comfortable with their track record and their ability to continue to productively manage their funds, because you're not incorrect in pointing out that the payment streams could be turned off in the future, and that could certainly limit the amount of available revenue coming in to support the facility.
But on the lender side of things, you're not seeing any kind of defaults when the pledge is of the fee revenue, right, through this period?
We have not had any, material types of events, witness material types of events of default in these products. Fee performance has generally been adequate to support any kind of financial covenants, at least in the deals that we have in our portfolio.
I've said this every year, this is one area where I will repeat myself. It is always such an honor and a privilege to have such brilliant partners as Wendy and Tram, Brian, Frank, and Kristin are examples of today, and I thank you all for being panelists, and I thank everybody for listening. Now, what I try to do every year, I am proud to say that in 14 years, I have never repeated my same kind of shticky type information and jokes and puns. This year, no exception. So what I did since the beginning panel of this year's IMU was to try and thread a 1001 Arabian Night Scheherazade type concept going throughout to keep you all coming back for more. Maybe inspired by this because my now 5-year-old granddaughter, and some of you 4 years ago, saw a picture of her eating her first bite of cake. She is into the Arabian Nights, and we're reading Sinbad and Ali Baba and the 40 Thieves and other relevant information. But my 1001 Arabian Night concept, which, by the way, was developed during the 8th to the 14th century, it took a long time, has been to present to you, those on this call, what the Scrabble experts have done during the COVID pandemic. They took a number of words or phrases, and the goal was to rearrange but use every single letter to come up with another word or phrase. So in the first one, for example, the eyes is rearranged to they see. George Bush was rearranged for he bugs Gore. Last time I talked about dormitory being rearranged into dirty room. Today I have, for everyone who can put up with this, 3 others. I have election results. These Scrabbles rearranged to lies, let's recount. Snooze alarms, they rearranged to alas, no more Z's. And lastly, a decimal point, they rearranged to I'm a dot in place. With that, I'm finished for today, Please come back next week at noon on Wednesday for our enforcement panel. And again, thank you, Wendy, Frank, Tram, Brian, Kristin, a wonderful panel, and we'll speak to you soon.